All right, we are here today with Kavin Sampath. Man, Kavin, thanks so much for being part of our class. This is awesome.
Thanks for having me, Mr. Simpson. It's great to be here.
Yeah, man, you're at UT Austin. You're in the business honors program. By the way, before I forget, here we go. Very honored. I got this right here. The students see this all the time. It was very awesome. Part of the top 5% last year. Very cool. Amazing. You got into UT Austin in their business honors program. What is that? How did you get prepared to get into it? What is it?
Well, basically, it's a concentrated version of the McCombs program. And so essentially we take similar classes to McCombs and similar classes to regular business
McCombs
at
is the
UT.
business program there, right? McCombs
Yes,
is the
yes,
regular
McCombs is
business
the business
program, and
program.
everybody, and you're in the business honor. Okay.
Yeah, essentially business honors is just regarded as like the top 5% of McCombs. And the reason is they put us into the same classes that McCombs students take, but the honors versions of them.
Okay.
And so the whole idea is that there's about 180 kids in BHP this year, which is actually a lot more than usual. Usually it's between 120 to 150, which bodes well for people applying next year and the year after. But essentially what it is they bring a close group of people together, and it's a very few amount of people, like I said before. But the idea is that everyone takes classes together, they get to know each other really, really well. And BHP students have resources like offered to them that maybe other Macomb students don't have. They have a bigger alumni network, better connected, that kind of thing. Overall, it's more of just a networking and kind of a launch pad thing. Obviously, the stuff that you actually learn won't be too different because I mean, business communications versus honors business communications is not going to have much of a difference to it. But when you get to the finance and accounting classes and you start getting to know all of your other business honors peers really, really well, those kinds of friendships, or so I've heard. I mean, I've just started the program, but I've heard they stay lifelong and you get a really good network when you leave college. So essentially, that's what it is. As for preparing to go into it, I don't really think there's much that you can do in terms of like making yourself a business honors student specifically, as long as you show an interest in business and you have a specific line. So obviously you don't have a lot of fluff, don't do a bunch of random things, have a goal, because UT's whole thing is they want to be able to make a difference after you graduate. They want to take you because they want to know that you're going to keep on following your passions. So if you follow a passion and you stick to it and you can show with your essays and resumes that there's kind of like a clear theme throughout it, then I think that's what they like to do the most. But obviously I can't say that for sure because I'm not an admissions officer. But
is it hard? I mean, is it like competitive? Is it like is this like this is like the Top Gun of business programs, and you're going there and now you're trying to compete with the other BHP students to say who's the Top Gun of the business world, or is it more of a collaborative effort?
It's actually been more of a collaborative effort, which I really, really enjoy. The whole thing about BHP is the most attractive portion of it is the fact that they're known for 100% placement. So if you get into the business honors program, they'll put you where you want to be in the future. So there isn't really a competitive nature. People aren't at each other's throats. They're not trying to kind of screw over the other person because they want an opportunity that they can't have.
Yeah.
It's very collaborative. If you find an opportunity, you send it to your friends. You're like, hey, check this out. It's really nice. Then again, I've only been in the program for a couple months now, but based off the upperclassmen I've talked to and the advisors, it seems to be very collaborative, which is really nice.
So if you want to work for the finance department for the Padres, you can. You'll be placed right in there. That's just part of this program.
I'm sure we have some sort of connection somewhere.
that's good. And by the way, some of these programs, like my friend went to USC Law School, and I remember him telling me how competitive it was there. Where like if the professor had you go to the library to research a certain precedent that was placed, people would get in there and read it and rip it out and take it out so the other students couldn't get it, and they would fail, and you would see, it was like there was like competitive element there. But you're also in the USIT, which is an investing team there. How did you get into that? What is that?
So basically, USIT is the University Securities Investment Team, and they're an investing organization within the University of Texas at Austin, and they're McCombs affiliated, which is something that's uncommon for other finance clubs. Essentially, organizations in college are going to be very different from organizations in high school at CHS because you have to apply to get in. And what's really interesting is that oftentimes it's harder to get into these organizations than it is to get into the school, which is really, really weird. But I know that almost every finance org on campus at UT that's known to be like a premier finance org or one that'll like teach you a lot is very, very selective. So they take probably 5 to 8 freshmen out of maybe like the hundreds that apply. Not that that should discourage anybody at all. I know I have friends that were rejected from all of them, but then they got into one, or they got rejected from all of them freshman year and then junior year, sophomore year, they joined one and they were completely fine. So there's absolutely no pressure at all. The
Yeah.
only advantage that comes with joining one earlier on, like for example, I got into UCIT this year. Essentially, what UCIT does is, as a junior analyst, they put you through an accelerated finance program. So I essentially am going to learn all of my sophomore year finance accounting classes and most of my junior year finance and accounting classes by the time I'm done being a freshman.
Okay.
And obviously, finance organizations are going to be a lot of work, but what they're there for is for you to learn, get ahead of obviously your peers and for them to be able to give you a good foundation in what you're interested in, which in this case would be finance. And
Yeah.
also, you get a really good network. There's a bunch of mentors in the form of upperclassmen that are able to give you a lot of advice on recruiting, internships, and oftentimes they can just plug you right where you want to be. So
Yeah.
it's more of a learning opportunity. The more passionate you are, that's what they really want to see. They don't really care how much you know. They just want to know that you're willing to learn it.
So why'd they pick you?
I couldn't tell you.
Come on, tell
I
me, brag on yourself a little bit. I mean, like, okay, so
I can't.
let me tell my students one thing. Last year or 2 years ago, when Kavin's in my incubator class, he comes to me and he's like, Mr. Simpson, I formed this charitable investments club. And I'm like, wow, this is super cool. And the whole point of it was to teach others about investing and so that they would learn. So you were teaching your peers here at Capel. And then like, oh, is this going to make Kavin a bunch of money? No. Kavin and all the other guys that you had in there too, that were all looking to do this. You were taking your earnings that you were earning from investing and buying peanut butter for the food pantry to help feed people who couldn't pay their bills and all that. I mean, it's like unbelievable. Is that part of why they took you, or is it just like you just got a lot of spirit about you?
Again, I think definitely like that just goes back to my thing, what I said earlier about like having a theme. Like I've been really passionate about philanthropy, being like the oldest person in my family, having to help out my cousins here and in India a lot. Like that's just something I enjoy doing. And so they kind of saw that clear path. And that was the reason that I think Canfield took me. But in USIT in particular, they not only look for whether you know about finance and you're willing to learn, but also kind of you as a person. They want to know, okay, is this a person that, as bad as it sounds, like, is this a person that we want to hang around? Is this a person that would be fun to hang around? Because obviously they don't want to be stuck with someone that's not a great person for 4 years. So honestly, I think that it was more of, I was very interested. I just told them I wanted to learn more about finance. They saw this. They actually ended up seeing the Dallas Morning News article, which may have helped me a little bit.
Yeah.
I think one of their grandmothers sent it to them and it was like, hey, look at this kid. And they're like, oh, we saw this kid like yesterday. So I was like, oh, okay, that worked out nicely. But mainly just honestly, just be yourself, be a good person, make them laugh. It's a very informal interview process before it becomes formal. So you kind of have to pass the vibe check before you pass the resume check. So it's kind of like the best of both worlds, I guess.
Gotcha. So I mean, I have some kids in my class that are coming in and they're trading Robinhood. They're doing different. They're already in investing. They love it, all of that. There's some kids that are just in here that are brand new learning. You're going to talk about bonds today. They probably couldn't tell you what a bond is, and that's okay. That's what this class is all about. What would be your investing strategy for what would you tell them about? This is how you need to, if you want to be successful financially, how should they invest?
You guys should do sports betting. No, I'm kidding. You
No.
absolutely not, unless you're betting on the Patriots winning. But I think that in high school, I had a very interesting view. I was like, yeah, okay, I'm gonna sit down every day. I'm gonna do options. I'm gonna trade individual stocks. I'm gonna check the market every single day. And when I came here and I joined USIT, I joined McCombs, I realized that actual investing is very different than what I thought I was doing. We're all retail investors at the end of the day because we don't have millions of dollars like hedge funds do. But the type of investing I'm learning now is for investment banking. So kind of like you pick one company, you pitch that company for the company to either put a large position into or for a private equity fund to buy out, transform, and then flip. I think that I would say stay away from options. As exciting as they seem, I got into options when the market was up, and then it went really badly when the market went down, like very, very badly. If you're gonna do options, use stop losses for sure. Sell, don't get greedy. Sell them very fast. If you just want a safe way to compound your money for the future, index funds. I was not a big fan of index funds for a while. Mr. Simpson knows this. I argued against index funds last year, but index funds, like index funds, ETFs, things that are going to be safe, definitely diversify your portfolio. Don't go too crazy. You can take some risk because like you're younger, you have time, but definitely as far as strategy goes, invest in, I'd say, bigger companies, blue chips. Don't do anything too crazy, especially with the way the market is right now.
Right.
Honestly, I would suggest bonds, but we'll get into that in a bit. So,
But Kavin, what you're saying is not sexy. It's not exciting. It doesn't, you're not going to get on the front page of Dallas Morning News or on CNN or anything like that saying, hey, I got 6% on my index fund. What's really cool is the 10x return I got on this Dogecoin last year or whatever, right? Like, how do you get past the stimulus that comes from crazy returns and just get comfortable with modest returns?
to be honest, that only happens when you lose everything. Like, I mean, you'll see periods of great gains. You'll be like, what are people talking about? I've made so much money. Like, I don't need this. I don't need to like listen to them. Like, forget index funds. I don't need them. And then when the market tanks and all of your options go down to zero,
Yeah.
and then all of your stocks take a massive hit, you start reconsidering. You're like, maybe they were onto something.
Yeah.
Maybe I need to be a little bit more modest.
Right.
And then when you come to college and you start spending a lot of money on food outside every single day, you start to realize, okay, maybe I can't risk what I have as much.
Right. And I was going to ask you
So
about that too. You're in Austin, which is a cool town, super hip, man. 5th and 6th Street, man. It's super cool, right? And your friends are probably like, let's go out. How do you manage, like, maybe not overspending, running up a credit card, all those kinds of financial? Because if you get yourself in a bunch of debt, by the time you graduate, you're not going to be investing a whole lot if you've got a bunch of debt to pay off, right?
yeah, I know 100%. And like I definitely identify with that because I'm trying to pay off my own tuition, help my dad out a bit. And I also don't have a scholarship. So I'm paying full in-state price to go to UT.
Wow. Okay.
What I would say is first year, it's definitely easier as far as I've heard because you have a meal plan. Most freshmen stay in dorms. Take advantage of the meal plan. Don't eat out as much. Eat at the dining halls. Take food from the dining halls. Don't let them see you take food from the dining halls, but take food from the dining halls. Always keep your fridge stocked with snacks. You get like dine-in dollars and a certain amounts of like college currency that you can use. Take advantage of that. Set a budget is what I would say. Like set like a strict budget as well.
Yeah.
That's very, very important because if you don't stick to that, things can go off the rail really, really fast. As for going out and having a good time with your friends, a lot of the things around here, you actually don't need to spend too much money to kind of go have fun. A lot of Austin is just outdoor. So
Yeah.
I've been able to go out with friends, go to apartments, watch movies, that kind of thing without actually spending too much money.
Yeah.
So obviously, as I go into college more, I'll figure that out. But I definitely think that freshman year, you don't really have the need to spend too much.
Right.
So create a budget, start building your financial discipline as soon as you get here. And that way that translates to when you move to an apartment in your second, third, and fourth years.
Man, that's great advice. I've been my whole first quarter of my class is about how to play defense and not overspend. And that's just not that doesn't really move the needle with a lot of people. Like, yay, it's like you see all these ads for Audis and spending money and all this stuff. And it's like, it's hard. The world is great at marketing consumption. It's not great at, at marketing, being conservative with your money. All right, let's take a look here. We're going to shift gears. We're going to get over to the bonds world as well. And this is, one of the exciting ways that we can invest is debt equity here. And I'm excited to have your perspective because bonds honestly aren't always it's not super sexy. It's not super interesting to a lot of people, but stocks and bonds are synonymous as peanut butter and jelly, as salt and pepper, as, they go together because they do different things within the financial markets. So what is a bond? You got 1 minute, Kavin. Go ahead.
All right. So a bond, I think, is less talked about because it's less accessible to retail investors. Like as far as I know, you can't go on Robinhood and buy a bond. You need to go onto an actual platform like TD Ameritrade, E-Trade, Fidelity, something like that. And essentially what it is debt. It's a line of credit, a line of debt. It's a loan, but not between a bank and an investor. It's between a company and an investor. So for example, let's say I have a lemonade stand. I need money to buy supplies. I would sell a bond. So instead of giving up equity in my company, I basically sell a bond with interest. And the person whose money I borrow, I will pay them a certain amount of interest, as well as the value of the money that I got from them at a certain point in the future. So that's like the most basic way that I could explain the bond.
Yeah, it's pretty, like, I know that sounds like pretty simple, but it's like that is really what it is. Instead of saying I'm going to give you 10 cents for every cup of lemonade that I sell, it's instead I'm going to pay you a percentage for this particular, for this expansion or these supplies or whatever it is. Okay, question number 2 here. Here we go. Let's see here. Let me get to the issue price. Explain to us what this is.
Okay, this is fairly simple. It's basically exactly what it sounds like. When a bond first gets issued, kind of like when a stock first IPOs, it's the price. So it's fairly obvious. Like as you can see in the example here, like the general obligation bond, it's basically going in at an issue price. So $5,000 is the sum of money, and then obviously they'll have a certain issue price to offset the interest that's being paid. So they're not going to say, oh, $5,000 immediately. That price is going to change depending on how much investors think they're going to make back from the investment itself. So issue price is essentially just the price that the bond gets issued for. So it's pretty
Yeah. And why did they issue it at different rates?
They issued at different rates based off of the level of risk involved. So there are different entities, and I think we'll get to that in later slides, but there are different entities that can issue bonds. So there are government bonds, and then companies can issue bonds. And then depending on credit scores and how safe a certain company is, the issue price can change.
Gotcha. Okay. All right. The coupon rate, always the favorite part here for the investor. What is that?
The coupon rate is essentially the same as like the capital gain that you get from a stock. The coupon rate is going to be that interest that the bond issuer pays the person that actually buys the bond. So for example, if you were to buy that bond for my lemonade stand and I said, okay, I'm going to pay you 10% interest on that $100 bond every single year, then that 10% that I'm giving you would be called the coupon rate. And I think that it's kind of confusing to call it the coupon rate because it sounds like there's a discount on it. But essentially what that just means, it's an interest rate that I'm paying you.
Okay. And why is the coupon rate higher or lower with certain companies?
It essentially all kind of ties back to what I said before in terms of the risk involved. If a company is if it's a startup and it's just starting out and maybe they have like a lot of debt, they don't have any solid ideas, they don't have a proper moat competitive advantage in the market, and there's a risk of the company going under, then their coupon rate must be higher because they need to incentivize buyers to buy these bonds over maybe a safer bond like a treasury bond or a municipal bond.
Yeah.
And so they offer higher coupon rates so that investors will be more incentivized to buy these because they're like, oh, I'm going to make more money.
Gotcha.
It's
Okay.
just the whole like balance between risk and reward.
Yeah, and I think when I had you a few years ago, we listened to a podcast about a junk bond, and they were Planet Money's team. They were buying a bond that was like 154%, and it was like highly likely that it was going to bust. I don't want to spoil it for the kids, but it's like it's super crazy risky. Like the average bond is like, I don't know, like less than 10%, right?
Yeah, it's the coupon rates are very, very low, which is essentially, that's generally why people move over to stocks some more. I think later when we talk about which bond you would take, there's a slide on that. I'm going to touch a little bit more on why you'd go with a bond over a stock. But when the market is good, generally people go to the stock market because they get higher returns.
Right. So when the market's going up, we go to stocks. When the market's in a bear market, we go to bonds because we're at least going to get a rate of return and not lose on that. Okay. All right, let's look at slide 4, the coupon date and the maturity date. Why do we have these? What are they for?
So I guess one way you could think of this is in terms of a stock. The coupon date is kind of like the day that you get paid dividends, and then like a maturity date would be like the day that you sell it. But these things are fixed. For a bond, they're 100% fixed. So a coupon date is obviously the dates when you're going to make that coupon interest payment. So you're going to keep on getting that passive income. And then the maturity date is the date when that company will pay you back the face value of a bond. And what the face value is essentially how much that amount that you loaned the company is. So that same $100 bond that I sold to you for my lemonade stand company, if I said that matures in a year, then I owe you $100 at the end of the year if my company is financially able to pay it back. Obviously, the risk with bonds, although that risk is lower, is if my company was bankrupt, I'm not able to pay you that bond back. That is the only way that you won't get back the face value of the bond because I owe you that money. The things that'll change in between are the coupon date, how much I pay you through interest, but those dates are fixed. And then the maturity date is when you get paid back the entire sum. So you won't get it paid back in chunks. You'll get the entire thing paid back at the maturity date. And until then, you'll be getting coupon payments.
Why does the maturity date factor into the value of the bond? Like the fact that if the maturity date is 15 years from now, it's less valuable than a maturity date that's 5 years from now, right?
Yeah, essentially, it's more of like the liquidity of money and the time value of money. You guys should look this up if you don't know what it is. It's a really interesting concept, but essentially, the time value of money is basically a dollar now is worth more than a dollar in the future due to something known as a discount rate. When you guys go to college and you learn about finance, you learn about like DCFs and like discounted cash flow models and that kind of stuff. But essentially, when you're trying to figure out how much a company is worth, or you're trying to do financial analysis, you'll see that cash flows for a company in the future aren't the same as their current cash flows because due to inflation and discount rates and interest rates rising, the amount of money they make in the future, that dollar is not worth the same amount as a dollar now.
Yeah,
So that's why when you loan money to someone, you ask for an interest rate because essentially you're paying for the inconvenience of not having that cash right now.
right.
So that's why if a maturity date is farther out, you're not going to have access to that cash for a long time. And so the interest rate needs to be higher in order to make up for the fact that you're not going to have that money till later. And that money later on is going to be worth less than it is now.
So waiting for a longer maturity date means that you're just not going to have that dollar. You're not going to have it back for you. Interesting. Okay. And I mean, I think that's really cool. That's like stuff I have to really sit down and like have strong coffee and really listen to a professor tell me that, because it's like to get my brain wrapped around it. I mean, Kavin, I'm a B- student at best here, right? And I'm trying to make sense of all this, all these complicated terms. All right, let's take a look here at slide number 5, the par or face value.
Okay, so this is essentially just exactly what it sounds like. Like I touched on earlier, the face value of a bond is just how much that bond is worth in terms of how much debt the company like took on. So if you borrowed $100 from me, the bond was $100. The face value of that bond is $100, and at the maturity date, the company owes you $100.
Okay.
So that's essentially what it is. It's completely stuck. That's the face value. It doesn't change. When the bond matures, that's the amount of money that the company owes you at the end of the term.
So Kavin, why do they do this? Why not just go to Bank of America and just get your little loan for your lemonade stand? Why does a company issue a bond instead of just getting a loan?
Essentially, it just comes down to freedom, financial freedom. I think the best example I could use would be actually the Charitable Investments Club, and the reason that we didn't bring the nonprofit to CHS as an official CHS club. If we did that, administration told us that they would have to control our finances. There would be limitations on what we could invest in, when we could take money out. And when it comes to investing in the market, if you miss out on a certain opportunity by a couple of hours, days, minutes, whatever it is, it can lead to a big loss. And essentially, it's the same with a company. If you're going to invest money into a company and you're trying to get this loan and you're trying to, invest it into capex or invest it into PP&E, essentially, if you don't act on it right away and you have limitations on you, like many of these banks give them, because the
Yeah.
banks obviously don't want to lose the money, right?
Right.
And so they're going to be putting limitations and certain statutes on these companies, like, oh, you can only use this money this way. If you do this, then the loan will get terminated. You can't violate these terms at all. And so there are strict rules when you're getting a loan from a bank, right? Because banks know exactly what they're doing. But
Right.
when a company issues a bond to an investor, there's more financial freedom because as long as they're paying that coupon rate or that interest rate to the investor, they can do whatever they want with the money. As long as the investor thinks, okay, I'm gonna get that money back later on. It's not as contractual of an agreement, and there's less limitations that the company faces. So
So
essentially,
you're
they're just getting more freedom.
So your lemonade stand, you asked me to do a bond for $100 and you're going to give me 10% return. And I can't tell you how to run your lemonade stand. You essentially can run it the way you want to. But if you go to Bank of America may say, here's the deal, Kavin, you got to use 12-ounce cups and you got to put ice in every glass. I mean, they may put things on you. Now, they're probably not going to get in the weeds of a lemonade stand, but they could get in the weeds of a company's business if they feel like, look, you're not going to sell any lemonade unless you put ice in there, right? Like they could get involved in that. Interesting that a company that would want freedom that badly. I just think that's so interesting. All right, let's look at price factor of the bonds.
Okay, so essentially, we can talk about here the credit rating and how this affects them. But basically, the thing that affects the bonds is the trustworthiness of the company or the issuer of the bonds themselves. Just like if you were to go to a car dealership and ask them for a loan or to finance a car and they check your credit rating, right? That's the kind of the same thing with an issuer of a bond. So there's like people that are more trusted, so like the US government, treasury bonds, those are guaranteed. Those are issued by the US government. They're backed by the treasury, like by the Federal Reserve. Like they're solid. Then you have kind of like what you touched on earlier, Mr. Simpson, with junk bonds. And those are companies that essentially are kind of like throwaways. They're running very high, they're very highly leveraged on debt. They
Yeah.
don't really know what they're doing, or even if they do know what they're doing, they're not sure if it'll kind of pan out in a way that will make them profit. And so you're kind of throwing up a shot and throwing up a prayer. And again, kind of back to what I said earlier, you might even be better off, sports betting compared to investing in one of those bonds. But
Right.
essentially, if they have a poor credit rating, then the risk of them defaulting on that bond or that loan that they owe you when the maturity date comes around is higher.
Yeah.
And so that's essentially what kind of factors into the prices of these bonds. And so on the right side, you can see different ratings for bonds. And those ratings from the top to the bottom are like kind of like the best to worst in terms of like trustworthiness of a bond. So definitely study that if you can.
Yeah. And by the way, when I looked at, my example bonds that I have here in a minute, I looked it up on Fidelity and I was looking for bonds and it didn't even like, it wouldn't show me the 145%. I guess there's somewhere else on their website that they don't want Simpson, the, random dude, teacher, investor guy going and buying these really super risky bonds. I don't know, maybe they're there. I didn't really hunt too much, but I know it's probably some clicks there that I'd have to put in to find them. Okay, let's look. Number 7, most common bonds. Here are your 4 most common bonds, which we're going to look at as well in just a minute too.
Right. So we have obviously the corporate bond, municipal bond, government bond, agency bond. I'm not 100% sure, but I'm pretty sure that they kind of go down in order in terms of like trustworthiness. So obviously, a corporate bond is going to be your company like Amazon, Netflix, Google. And then your municipal bond is going to be government, but like local. So kind of like your city, your county, stuff like that. Government bond is going to be stuff that will fund infrastructure, like maybe highway building, roads, that kind of thing. Agency bonds I actually have not heard of before this. This was new to me as well. But other than the Treasury, if another agency were to issue a bond, so like for example, maybe like the EPA, that would be considered an agency bond. So I guess like I would maybe put agency and government on kind of like the same platform in terms of being backed by like a very trustworthy entity. But I think the most important bonds for you to know are corporate, municipal, and government.
Yeah, and I think agency bonds has something like they're a Fannie Mae and Freddie Mac one as well, where those are lenders to like first-time borrowers as well, and so they bundle these together, or they issue bonds to help provide people to be able to get their home for the first time as well. I wasn't familiar with those either, but those are what when I was doing my research, I found all these. Okay, so we got Leonard. And Leonard has 4 options that he's thinking about. He's thinking about either a bond with Kraft, which by all the way, all these were found on Fidelity. Here's Kraft's bond that you looked at before. Then he has an option here from the Home Depot, 3.9 coupon rate, 1,050 is what the issue price is of it. The government bond, a T-bill, basically $1,000, pretty low return, 2.25%. Or we've got the municipal bond here, the Trinity Valley Authority here of Texas. I believe it's right down in Euless, is a pay frequency semi-annually, 2.5% coupon bond as well. It's going to mature in just a few years. Which of these would you recommend Leonard to take?
So obviously, without going into the numbers, I kind of want to take a little bit of a different approach to this. I want to go at it a little bit more of a broader and holistic review. Like when you look at these bonds, what are the first things that you should notice? Obviously, you should notice the type that they are. So you have 2 corporate bonds, a government bond, and a municipal bond, right? So immediately in terms of trustworthiness, you should know, okay, well, the government bond is going to be rated better than the municipal bond, and the municipal bond is going to be rated better than Kraft and Home Depot, obviously. Right. Now, in this case, Kraft and Home Depot are generally like they're blue chip companies, with Home Depot being a little bit larger, a little bit more trustworthy. But you also have to take into account macroeconomic conditions. So for example, what is currently going on right now? Why do bonds go up when stocks go down? Well, when stocks are up because the economy is good, it's because investors always follow the rate of return. Where are they going to make the most money? Right. Now, when the stock market is up, that's because interest rates are down. When interest rates are down, companies are able to take out loans at lower interest rates. Taking out debt costs them less money. They're able to grow their businesses faster, right? Now, on the other hand, when interest rates go up, that increases bond yields because interest rates go up. The amount of money that you make off of a loan goes up. And essentially, since a bond is like a loan, the money that you're going to make back, the coupon rates for bonds go up as well. And so the opportunity cost of moving from bonds to stocks becomes much higher. All of a sudden, you're missing out on more gains than you were before. And investors they do switch back to bonds in order to kind of look for a more safer, almost more guaranteed kind of return. And so especially in an economy like we're in right now, where interest rates are rising, inflation is rising, and I believe the Fed hiked up rates, like 0.75% last time, and they're like projecting to do so well into the future, to the next 2 years. And so what I would say, I would actually go with the Treasury bill, just because Treasury bonds, they also increase opposite, indirectly with the stock market, and with downward pressures on the stock market right now, just from like a holistic macroeconomic view, the Treasury bill to me would be a lot more appealing than it would have been in the past. So I wouldn't count that one out just because of the low rate, especially because Treasury bills are guaranteed as well. So I would definitely, in my opinion, I would either go with the Treasury bill or the municipal bond as well, just because of the way the market is going right now and the way companies like Home Depot and Kraft Heinz are being affected by supply chain issues. So yeah, I would go with the Treasury bill without looking at any numbers, like just like looking at it right away. I would lean more towards going towards a T-bill for sure.
Well, Kavin, man, you've been awesome. Our time's almost up here. You've been great. Thanks so much for coming in and being part of our class.
Yeah, of course. Thank you for having me. It was great talking to you guys.